Welcome back to The Explainer. So take a quick look at that smartphone in your hand, or whatever device you're streaming this on right now. I mean, it feels like magic, doesn't it? But today, we're actually unpacking the fascinating physical reality, and frankly, the massive economic paradox unfolding behind the scenes to make that connectivity happen. We're zeroing in on Ericsson, a major global telecom giant, and exploring a really interesting mystery. How exactly can a booming historic technological shift simultaneously act as a double-edged sword for the very companies building it? We're going to dig into their 2026 data to understand this intense tug-of-war between skyrocketing network demand and some seriously crippling supply chain realities. To really put the scale of what we're dealing with into perspective, just look at that number, 3 billion. According to the June 2026 Ericsson Mobility Report, 5G subscriptions globally have officially crossed the 3 billion mark. Think about that for a second. We aren't just talking about the future of connectivity anymore. We are standing smack in the middle of it. The adoption of 5G is absolutely massive, and it's completely rewiring how data flows across the entire globe. Okay, let's dive into this a bit more. That 3 billion subscriber base, it's not just sitting idle. Between the first quarter of 2025 and the first quarter of 2026, mobile data traffic grew by a staggering 22%. And that growth actually blew past market expectations. So why the sudden surge? Well, it's because the explosive growth of artificial intelligence is becoming deeply, deeply embedded in our devices, our vehicles, and even our cities, all of which rely on 5G. This integration of AI and 5G is driving an unprecedented push for raw, unadulterated network demand. So here's our roadmap for today's explainer. We'll start with the 5G and AI boom, look at how Ericsson makes money, examine a tale of two quarters, unpack the AI cost dilemma, and finally, look at the path forward. Section 1. The 5G and AI boom, a connected world. So the crucial point the June 2026 Mobility Report makes is that we've definitively entered an era where AI, the cloud, and mobile are all working in tandem. Not only do we have those 3 billion subscriptions, but half of all global mobile data traffic is now carried over 5G networks. On top of that, 71% of fixed wireless access, or FWA providers, are now offering their services over 5G. We're also seeing a huge jump in commercial 5G standalone network slicing offerings, hitting 84 in just a 6-month window. And if you're wondering what on earth is network slicing, it basically lets operators carve out a dedicated VIP lane on the internet for super demanding tasks, like autonomous driving or enterprise AI, so they don't get stuck in the usual internet traffic jam. The takeaway here is that mobile networks are moving way beyond just basic, best-effort internet. They're becoming intelligent, absolutely critical infrastructure. Moving on to Section 2, how Ericsson makes money, the business model. Breaking down Ericsson's expected $25 billion revenue for fiscal year 2025, you can see exactly where their bread is buttered. 65% of their total revenue comes from their network segment alone. Cloud software and services make up 24%, and enterprise and other account for that remaining 10%. As you can see, they are heavily reliant on core network infrastructure to drive their overall business. That massive 65% slice, that's the network segment. Simply put, this is the actual physical hardware and the deployment services needed for radio and transmission networks around the world. So whenever your local telecom operator goes out and upgrades a cell tower so your phone can handle faster AI apps or stream 4K video without buffering, they are literally buying the physical products that make up this exact segment of Ericsson's business. Section 3. A tale of two quarters. Q1 versus Q2 2026. Now, what's really fascinating here is the sheer contrast between their top-line struggles and their bottom-line resilience. If you look at the year-over-year sales change, Ericsson faced a rough 10% decline in Q1, which only softened slightly to a 6% decline by Q2. But here's the kicker. Despite those declining sales, their gross margin actually improved. It went from 47.2% in Q1 up to 48.4% in Q2. And you've got to check out that net income jump. They went from just 0.887 billion Swedish krona in Q1 up to an incredibly impressive 4.076 billion in Q2. Diving a bit deeper into those Q2 numbers really shows us where the pain points and the bright spots are hidden. Their core moneymaker, that network segment, declined by 8%. The enterprise segment took a really sharp drop of 19%. Though, to be fair, that was largely due to them divesting a business called iConnective. The real bright spot was cloud software and services, rising by 3%. But hey, don't feel too bad for them about those slipping sales just yet.
At the end of the day, Ericsson is sitting on a veritable mountain of cash, almost 60 billion Swedish krona in net cash. That gives them an incredibly solid foundation to stand on, even with a shifting sales landscape.
Section 4. The AI Cost Dilemma. A double-edged sword. And this brilliantly illustrates the whole problem. If AI and 5G demand are booming, and networks are becoming essential infrastructure, why on earth are core network sales slipping? Well, it comes down to this massive paradox. On side A, you have AI network demand. As AI gets baked into all our devices, the sheer volume of data is pushing telecom operators to buy Ericsson's tech. But over on side B, you have AI data center demand. This huge, global build-out of AI data centers is absolutely gobbling up the world's supply of memory chips. And guess what? Ericsson relies on those exact same chips to build their networking hardware. So AI is creating demand for Ericsson on one hand, while simultaneously ruining the economics of their supply chain on the other. Listen to this direct warning. Ericsson's executives actually flagged this rising component cost as a major risk during their Q2 report, stating bluntly, AI data center demand is tightening memory chip supply and pushing prices higher. It's a pretty stark warning, right? The very technological revolution that is driving the long-term demand for their products is putting an immediate, incredibly heavy financial squeeze on their bottom line right now.
Finally, Section 5, the path forward, mitigation strategy. So how exactly do they defend their margins against these rising component prices, especially in a pretty flat market for radio access networks? Well, let's see how this builds. CFO Lars Sandstrom outlined a clear three-step strategy to protect those improving gross margins we talked about earlier. Step 1, they literally just have to raise prices to offset those expensive memory chips. Step 2, they are actively redesigning products, maybe to use components more efficiently or even to swap out parts that are super constrained right now. And step 3, they are renegotiating customer contracts. They need to ensure these harsh new cost realities are being shared with their partners, rather than just being eaten entirely by Ericsson. What's absolutely vital to take away from this is that Ericsson isn't panicking at all. They are maintaining highly disciplined execution. Because of that mountain of net cash, they can weather this supply chain storm and still return capital to their shareholders all throughout 2026. They already scheduled a dividend payment in April. They successfully navigated that really complex Q2 report in July, showcasing their margin resilience, and they have another dividend payment already lined up for October. Which leaves us with this final pivotal question. Can Ericsson capitalize on the AI boom before the supply chain costs slow them down? Think about it. They have the technology, they've got the cash, and they definitely have the market share. But balancing the soaring demand for these intelligent 5G networks against the skyrocketing costs of the chips required to physically build them, that is going to be the ultimate tightrope walk for them in 2026 and beyond. Thank you so much for joining me on this deep dive today. Keep learning, keep questioning, and I'll catch you on the next explainer.